And some of them wanted to get a stake in Florida because they were worried prices would go way up, and they certainly did after that. So if they wanted to move down here, they had something that would cover some portion of it. And we said, well, you can't justify it based on your numbers, client, on the math. But if this is a lifestyle choice, you don't have to, everything's not an investment. You know, you could do something because it's fun. You know, I went to a football game. It was fun with the Kirks. It was awful because of the team stuff. But it could have been even more fun if they had played well. We went to the basketball game. It was a ball. It was a root for them. I was probably as adamant as these guys. It was fabulous. Those guys were terrific. But it doesn't have to be economic. So if you think of that as a lifestyle choice, we want to invest in Florida so it's there, and then if rates go up over there, we have a stake in there. And here's the net cost of it. That might be worth them instead of having a fourth car. Could they afford it? And our concern is that they have a balanced financial inflow-outflow. If they can afford it and they want to do it, fine. If they can't, we don't come back and say you can't do it. We're saying, what do you like to do less? And if it's more important to have that than the fourth car, the third boat, you know, an extra trip to who knows where, the cruise, fine. Our concern is don't get yourself into trouble by overcommitting. So with a real estate situation, if they're looking at it as a pure investment, I think you have to go through their own math as to what they think that it will appreciate to, best estimate in terms of price changes, what the risk and reward, and make sure that that property, they are cognizant of what level of risk they're taking. If it's 80% of their net worth, they're taking a huge risk. Now, they may win real big time, and it depends on their risk tolerance. So you can't answer a question generically, should invest in real estate. I mean, it depends on the cycle. But the diversification, the classification, the discipline, and doing the math, I think are critically important. Dawn, you have a follow?
This comes on portfolio balance. Would you be alarmed at a percentage asset distribution of 50% in real estate?
Yes.
40% in equity, 10% in cash?
Our policy, again, that's us, not doing anyone else. We will not take an account that has less than 50% out of the market. We will not take it. If somebody wants to come in and do that, they can't be a client, that's fine, that's their right. I think that is very, very risky. They may be successful. I mean, everybody has a right to do their own choosing, and if they pick something and put a huge percentage in and they win, you know, that's terrific. Statistically, it is not a good principle. And if somebody comes to us and let's say they have 800 units of something, and they turn that over, if we're 50-50, maximum 50% in the market, we'd have up to 400 of the 800 in the market. That's our maximum. If they happen to have 200 more units, they want to do something with it somewhere else and have it in the market, they end up 60% in the market and 40% out of the market. And we'll help them, but we don't believe that people should take undue risks with life savings. And it's not variable. We don't say we recommend 50. If someone wants more aggressive, we won't handle it, we'll help them outside, or they ought not to be clients. Somebody who do what that person is suggesting is very risk oriented, and that's their own choice. But it's certainly not what we would ever do or recommend. I mean, you know, they could double or triple their money, or they could go belly up. And that's not who we are. We're very values based. Who else? Anyone else have a question? Yes, ma'am.
When you were talking about liability insurance, which category were you talking about?
Well, liability insurance is personal. You have to, if you're working in a business, that's totally separate. So if you're a professional engineer, you have to carry professional engineer's insurance, known as E&O, errors and omissions and things like that. But this is the things that they call an umbrella. It goes over your base policy. And it would cover things like somebody trips in your home. It would include a car accident type of thing. It would include many policies. The policies could vary. Libel, slander, things like that on a personal, not on a business basis. So if I called somebody at something or other, if it's business based, I'm not that person. So I've got to make sure it's personal. And there are some limitations. For example, many of you, I mean, these are very impressive bunch of the comments and everything are really terrific. And with this group, many of you are on boards of directors. And umbrella policies will vary, they're not the same. Usually they'll exclude any activities as a director or officer of any business, any corporation or a business entity. Many of them have an exclusion to the exclusion. It says that doesn't count if it's for a not-for-profit organization. So if you're on a board, policies vary, it's not every one. Some of them will give you certain coverages, but if somebody does something in discriminatory way, whether it's age, gender, or whatever, or racial or religious, I think the policies are not applicable. So it covers things like that, but each policy, would vary. So I can't talk about everyone being the same. But we've had clients who have been on both sides of the umbrellas and mishaps. And I remember one had a party, went on at their house, and somebody ended up getting killed in a vehicle accident afterwards, where they were drinking. And they had an umbrella policy. It was tragic. And a stranger. And we had one that was a young person that was permanently disabled as an infant in a Colorado accident. And the jury there had the biggest finding ever. And there wasn't the coverage there. Again, this is the other way. But you need to have those things if you have assets. Again, chances are you'll never need it. Insurance is not to cover the small things for people who have assets. Cover the things that you can't afford to have happen. And we look at deductibles and timing and things like that. Well, one example I should about lifestyle. If someone, most of you, I deal with a very successful group. If you had a $500 or $1,000 deductible on your house or your car, if you had a mishap, virtually everyone here, no one's going to like that, but you could afford it, probably, right? Let's say that if you have that on your car, you feel like, or you have an older car, as soon as you take it off, you're going to have an accident. Okay?
Statistically, that's true.
You in the professor of statistics here, probably.
Yeah.
The statistics are that, on average, the insurance company's going to make money. So you're not going to get back as much as you put in, whether it's Las Vegas or insurance companies. But if you feel that way, if you want to have the coverage, is it for economic reasons? No, it's lifestyle. You might feel better having it, right? But it's okay. That's a choice. If you say, I'm going to be that way. By the way, if any of you have American Express, I'm not American Express employees, you can sign up if you have car rental. The car rental insurance for liability is extremely expensive, right, per day. American Express, you have to sign up for it. It's not, then it's supposed to be there, but you have to verify it yourself. They have a program for $20, $19.95 per rental. It'll be primary coverage for you. So if you're renting a car for a day or a week, I think there's like a month maximum, that's the total charge. So if I'm going to New York City and I have a car and somebody's parking it and I hear a screeching going up there, even if I have other coverage, for $20, I'm happy to pay that. But not that I want to hear that screeching, but I don't feel so bad. So these choices, you have to define lifestyle and economics. And it's fine to make a lifestyle choice. Right? It's not that, if it costs you more, if that's what you want to do, just call it what it is. Right? Somebody goes out and they want to get a little extra thing on their car, that's a lifestyle choice. They have a more expensive color, they want an extra this or that. Nothing wrong with that, as long as you can categorize it. So I don't know if that answers your liability question.
Do you buy that as an umbrella? Is that how you buy the policy?
Yeah, most of the insurance, without getting personal, do you know who your insurance company is? And again, that's not personal. You with a State Farm, or you with an all? You just call your agent and says, I need an umbrella policy, $1 million, $5 million. I want to go over what the coverages are, what is excluded. Because if you're on a not-for-profit board, you want to ask that question, right? And what the limitations are. Yes, ma'am.
Just a quick question.
Sure.
And it's a personal question, but we're at the stage where grandchildren going to college. Is there a vehicle that would be tax-wise for us to be able to funnel funds for our grandchildren to go to college that we can get a tax benefit?
Not necessarily, but there's tax efficiencies. There are 3 vehicles that come to mind. You can open up a 529 plan, right? And that gives the money tax-free to the grandchildren. doesn't really help you. You don't get a deduction. Some states give you a state deduction, which would be small. Florida doesn't make any difference. You have no state income tax. And you can change beneficiary. So if you have 3 grandchildren, I've got how many? You said you had 2.
16. You're paying.
You can open it up and you be careful, in one child's name, you can change that at your own will. And you don't even tell the person. And you can have for all of them, and if somebody doesn't go to college and the next one needs it, you can change the beneficiary. You can do $14,000 a year per child, and it counts toward that. You don't get a tax deduction federally, but the money goes to them tax-free, and it can grow, and it's in an account. That's one. The second one is a custodial account. You could be the custodian, the parent could be, your child could be the custodian. Depending on the state, at 18 or 21, that child has a legal right to it. Now, we've never had a case in 35 years where a child's come back and said, Mom, Dad, I'm taking it, because they're not going to get a penny more ever again. But that's a risk. The third one is you can set up trusts. And the trust, and there may be state laws that are different here, so you'd have to check with Florida law, and I can't speak to that, even though we have attorneys on our staff. You can set up a trust and put that money in there and have it that you have control of when to pay it out to that child. It's irrevocable, grandchild. However, in general, until the child becomes of age, 18 or 21, they would have to have a right one time at that age, because they're not at that age yet, to say, I waive my right to take the money out at that point. And that's a risk, because they don't have to. And we have accounts every year that are over 21. Money goes in and the child signs a thing, and then the parents could pay out income over 20 years, principal as needed. But you have a younger person, you have that risk, at least in the states that I'm familiar with, where they have to sign off for it to be a gift. And you have $50,000 per person. The 529 plans, you can pre-fund 5 years. So you put $70,000 in, but you're done for 5 years with that grandchild. So the 3 basic things would be the 529 plans, which are pretty common, the custodial accounts, and also the third one would be the trust. The trouble with the custodial accounts, if your children are successful, and like they probably are, is a thing called the kiddie tax, and the custodial account, the income is going to be on your children's tax return. So the 529 plan might be your best bet. And if you have interest, you can do them in any one of the states, and we shop for better states for people's situation. They're under different state laws. The 529 might be your best bet, because you can change beneficiaries if you want. Any other question? Yes, sir.
I was going to say, if anybody does want a copy, stop at the table out here, we'll get your name.
I have some here.
And
the
run out, we'll take your name, we'll be happy to send it to you.
Okay. Any other questions?
One quick.
Yes, sir.
I seem to miss your ratios that you mentioned a while ago about how much in the market, how much out of the market, how much cash. I missed that. If you said it, I missed it.
Well, it depends on the individual. I use it as an example, or our most extreme, that we wouldn't touch something that has more than 50% in the market. Out of the market for us includes cash and equivalents and CDs and stuff, investment grade bonds, that means a certain standard, whether they're taxable, tax-free municipals, or government bonds, certain utility stocks, and some funds that hold bonds. And those would be basically the categories, and at least 50% is there. But your situation could be very different than someone else's, and you need to come up with what that is. I mean, for example, a 23-year-old person who's got a good career potential, single, can afford to take more risk, in theory, maybe, than someone who is already retired, where it's not easy to go back to work. So I wasn't suggesting a mix, except that people respect it and don't let 90% be in